Hi, I'm James Robinson, and this is my stock pick of the week. This is the final section on the company SEI Investment Company, symbol SEIC. Today we're going to talk about the company's balance sheet. So the first thing you think about when you look at a company's balance sheet is you want to know how much cash equivalents, and marketable securities they have. Everything else is a little bit fluff, right? But what we really care about is how much tangible hard assets does this company have. So when you look at this company, you'll see that the cash and marketable securities has gone up every year since 2011. It's gone from about 450 to 900 million. So they've doubled the amount of money that they have in cash and marketable securities. And that's in addition to having bought back a bunch of stock. That's in addition to paying back a bunch of dividends. So the company is consistently building up its reserves. We also know from other slides, and we're going to talk about it in a minute, that that $900 million is being productive and is generating profits for the company. And that's also on top of the company having no debt. So cash equivalents, marketable securities, the company's in great shape. I actually would prefer they frankly had a little bit less cash. They gave some more back to us, the shareholders, increased the dividend a little bit, but I'm not going to complain too much. So the next section, this slide is current assets and current liabilities. So for those of you who aren't accountants, current assets are assets that can be converted into cash within a year. So receivables, marketable securities, loans that have a very short time frame to get paid back, those kinds of things are current assets. Current liabilities are obligations they have to pay within the next 12 months. So you like to see there being a significant gap between current assets and current liabilities. And you also like to see the current liabilities going up at a rate that is not too dramatically out of whack with what the profits are doing. So you like to see profits sort of going up at the same rate or faster than current liabilities. That means the company is creating profits faster than they're creating demand for cash. When you look at this slide, you'll see that current assets have gone up pretty dramatically. They've really almost doubled since 2011, and current liabilities have gone up hardly at all in that period of time frame. So that's another example of why I really like this company. It's simply not capital intensive. It's very, very well run. It's very conservatively run. So this slide is really encouraging. By the way, as is almost every slide for this company. This company is not debt-free, but it doesn't have very much debt. So the slide on the left is interest expense and interest income. So this company has $900 million in cash, and they're using that cash. They've invested it. It's making some return on the money, about $17 million of profit. The company pays, less than $1 million in interest on its debt. So effectively, their financial position, borrowing versus being a lender, is generating about a $16 million profit for the company. So that's spectacular, right? No reason to be concerned. We love the financial strength of this company. The next slide, it just gives you a sense of scale. So you sometimes will see interest expense increasing, but when you look at it in the scale of operating income, you find that it's not that bad. So this company's interest expense as a percentage of operating income is infinitesimal and not even worth discussing. I used to do a presentation that was just on debt. I modified that to be the balance sheet because so many of the companies I look at don't have any debt. And I want to be able to highlight to you exactly why that's so important. So hopefully these two slides give you a sense of why I like companies without any debt. So we've talked about current liabilities. That's obligations you have to pay somebody some money in the next 12 months. Long-term debt is debt which is due, but more than a year from now it's due. And so when you look at the company's long-term debt, effectively it has zero long-term debt, something in the neighborhood, I think, of $47 million. It's really almost not worth talking about it, so we're not going to. It's less than a month's earnings, or maybe it's just about a month's earnings. Total current liabilities, you can see, have been relatively flat. They've gone from about 150 million to about 300 million since 2010, so that's 10 years, and they've doubled, but the income has done much better than that. So great company. Current liabilities aren't a problem. Long-term debt is perfect. Just everything about this company is solid. So interest coverage ratio is a measure of the company's ability to meet its interest payments. And I'm not going to spend a lot of time on that for this presentation because the company's interest is so insignificant, especially when you consider the amount of interest income it has. So I like companies that have an interest coverage ratio of 3 or 4 to 1 as sort of a minimum. This company's interest coverage ratio is, call it 45 to 1. So it's, fantastic. The next slide, and really the final slide, is years income to pay off long-term debt. I like to see companies that have the ability, should they choose to pay off their debt in a reasonably short period of time. 3.5 years, 4 years, something like that. This company could pay it off, again, I've said multiple times in this presentation, in a month. So debt isn't a problem. The balance sheet for this company is absolutely rock solid. Everything about this company is rock solid. And if you were to listen to anything I say on any of the videos that I've done, buy stock in this company, forget you own it. 10 years from now, you'll be a much richer investor. Thank you very much for following me. I'm going to do an interesting couple slides this week looking at dividend investments based on how crazy this market is. So hopefully you'll tune in for those. In the meantime, please remember to like or subscribe and drop me a note in the comments about where you're from. Thanks for your time.